In this episode, we discuss some recently released student loan regulations that may be relevant to your repayment journey. Let's get started.
Let's get some money.
From New Money, New Problems, it's the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen. Negotiating compensation, purchasing your first investment property, helping your family with money, the highs and lows of entrepreneurship. New Money brings new problems that require new solutions. Join us as we work through them together. I'm Brenton Harrison, and this is the New Money, New Problems podcast.
Hello and welcome to another week on the podcast. If you are a member of our Escape Student Loan Debt community or our New Money, New Problems community, you are listening to the same episode today. As we have shared in the past, Escape Student Loan Debt is a separate entity from New Money, New Problems, but we serve similar audiences in one regard, and that is when you are a young, high-income earner or a person of any age that has federal or private student loan debt, it impacts your wealth journey. So when we have some news in the student loan space that impacts both audiences, we share an episode like this across platforms. Now, if you're listening in our Escape Student Loan Debt community and you do not listen to the New Money, New Problems podcast, first, I would encourage you to do so. But if you don't, last week you missed an episode where I shared the details of how I misplaced, is how I'll put it, $33,709. And I told a story about the journey to recovering those funds. Not a fun story, but I can report that I received communication from the IRS that my refund is on its way. So I will keep you all up to date with that journey, and I'll let you know when I finally have our money back, because as I shared, I had to tell my wife when I logged on and saw what had happened. But this week, what I wanted to do is share some finalized regulations from the Department of Education that were released literally today. It actually changed the episode that I was planning to release on Friday morning. So I thought it would be helpful to go through those regulations in full and give you my perspective on what it means moving forward. So if you're looking on screen, and we're going to put a link to this press release in the show notes, you're looking at something that's titled Fact Sheet: Trump Administration Implements Student Loan Provisions of the Working Families Tax Cuts Act. So there are things as it pertains to the repayment plans that are available, loan limits for undergraduates, graduates, Parent Plus loans, even things like loan rehabilitation. So what I'm going to do is I'm going to go literally bullet point by bullet point through some of these finalized regulations and talk about what it means. We're going to start with loan limits, and it says, and I quote, beginning on or after July 1st, 2026, graduate student loans are capped annually at $20,500 with an aggregate cap of $100,000, and professional student loans are capped annually at $50,000 with an aggregate cap of $200,000. What does that mean so far? It means that you need to know the difference between a higher education degree that you're pursuing and whether it's considered a graduate degree by the Department of Education or a professional degree, because the difference is for graduate degrees in total, you're going to be capped each year at $20,500 per year and $100,000 in total. Whereas if you have a professional degree, it would be a $50,000 annual cap with an aggregate limit of $200,000. Let's skip ahead a little and talk about what is considered graduate versus professional. There's a section that says, building on the statutory definition contained in the Act, the department arrived at the definition contained within the final rule, which achieved consensus among all stakeholders represented during negotiated rulemaking. The definition includes a list of 11 core program fields: pharmacy, dentistry, veterinary medicine, chiropractic, law, medicine, optometry, osteopathic medicine, podiatry, theology, and clinical psychology, end quote. So if you are pursuing a degree in those fields, it is considered a professional degree that qualifies for higher loan limits. What does this mean? To me, it's going to have a devastating impact, especially on private colleges that have degrees that cater to majors that would now be considered graduate degrees as compared to professional degrees. The concept of a cap in general will have a devastating impact on all of these fields, whether graduate or professional, because I can tell you definitively that in many of these fields, especially law and medicine, if you're going to a private institution, some of these caps are things that won't even get you through the first 2 years, much less a 4-year 4-year-long program, which could mean that many people might get into these programs and just decide not to go because they can't make up the difference financially, or even worse, they may lean on private student loans to make up the gap, which wouldn't be eligible for forgiveness, wouldn't be eligible for public service loan forgiveness, and have much less flexible repayment terms than when compared to federal student debt. Going back up to loan limits, it says for the first time, Parent Plus borrowers are also capped annually at $20,000 with an aggregate cap of $65,000 per dependent. Now, where does this come into play? For graduate degrees up to this point, now we're talking about loan caps, but for graduate degrees, there has been a long period of time when there was no cap on how much a student can borrow. For undergraduate degrees, however, there has been a cap for years as to how much a student can borrow. And if you went to a school where the expenses were just very, very high and you had capped out yourself in terms of what you could borrow as a student, you had the ability to go to your parents and have them take out Parent Plus loans on your behalf. As an example, you might go to a school like Vanderbilt where all-in costs are now exceeding $100,000 per year. Well, if you can't make up that difference on your own, you may have a Parent Plus loan that a parent takes out where you're the student, but they're the borrower for $50,000 for each of the years that you're in school. And now when you leave, you have a parent that has a couple $100,000 worth of student loans that they took out on behalf of their child. Now, I am not arguing that that's a good scenario. We talk to people all the time whose finances have just been torn apart by the journey of repaying a Parent Plus loan, but at the very least, it was an option, and you had the right to decide whether that was something you wanted to pursue or not. Now the Department of Education is saying you don't have that option. It's $20,000 per year per dependent and $65,000 in total per dependent. Now that is, for most schools, a decent amount of money, but it also leads to the possibility that there will be a child who gets into the college of their dreams for an undergraduate degree, but for reasons not just in terms of the amount of aid they receive, but even being able to make up the gap with a Parent Plus loan, they either decide not to go or have to turn to private student loans. So it's not like they're just doing away with this problem. It's more of a shifting the responsibility from the federal government to either the student who decides not to go, or putting them in an even more precarious situation by forcing them to take out private student debts with less flexibility for repayment and no options for forgiveness. Next up, the lifetime limit. It says all borrowers who receive a loan made on or after July 1st, 2026 are subject to an aggregate lifetime loan limit of $257,500 with narrow exceptions discussed below. Now, it's important to note, as is the case with most of the things we're talking about in this episode, that if you're already in the middle of a degree and you have taken out a loan for that program, then you're what I would call grandfathered in. It's not something where you're going to have to be likely to worry about these limits. We're more so talking about the specter of people who have not yet started a degree and those moving forward. But that is the section on loan limits. Next, we're going to go forward to streamlining repayment. We've talked about this ad nauseum on both platforms, the winnowing down of the available income-driven repayment plan programs or just repayment programs, period, to a smaller list of options. They are going to be moving towards a system where starting on July 1st, 2026, there's going to be a new repayment plan available, the Repayment Assistance Plan. And importantly, if you are already a federal student loan borrower before July of 2026, you'll have access to this plan in addition to the ones that are currently on the menu, those being the income contingent repayment plan, the pay-as-you-earn plan, and the old and new versions of income-based repayment. Now, if you are someone who, again, is borrowing their first loan after July 1st, 2026, the Repayment Assistance Plan, in terms of options that are based on what you make, will be the only income-driven repayment plan available. So for those who already have loans, this is an added option for those who are going to borrow after. So even if you currently have loans but borrow a new one after July 1st, 2026, Repayment Assistance Plan is going to be your only IDR plan available, which also means that if you're trying to pursue public service loan forgiveness because you work for a nonprofit or in government service, Repayment Assistance Plan is the only payment plan that you can use to pursue that option as well. Additionally, even if you're not using an income-driven repayment plan, they are launching a new tiered version of the standard repayment plan. The standard repayment plan is exactly how it sounds. It's a standard option where the amount that you pay is designed to pay off your loan in full over a given period of time. Now, based on the amount that you owe, they're going to give you with this new option anywhere from 10 to 25 years to pay off your debts. And I told you in the past episode where we talked about Repayment Assistance Plan, I'm not a big fan of these cliffs where a dollar here or there makes a tremendous difference. For example, let's say you're trying to pay off your loans in full, but you also are trying to not have the biggest payment possible. Well, literally what they're saying is if you owe $49,999, you have 15 years to repay it. If you owed even a dollar more, they'd give you 5 years longer, which may be better for your debt to income ratio, makes it easier to apply for things like a home loan or a car loan. And to me, I'm just not a big fan of $1 here or there making a difference. I mean, it's almost to the point where you might go borrow an extra dollar just to make sure you have 5 years longer to repay in that circumstance. But this is how the tiered standard plan will be structured. Now, there are some smaller elements of these regulations in terms of the number of people that they impact, but to those who are impacted, it's not very small at all, starting with loan rehabilitation. Loan rehabilitation is a process for people who have defaulted on their federal student loans, which means they are months and months behind. Won't go into the details, but it is, as I've shared in the past, one of the worst financial circumstances in which you can find yourself. In the past, there has been a process for people who have had defaulted loans called rehabilitation. And when you have rehabilitation and you have a 9-month period where you make on-time voluntary payments, they'll essentially restore some of your privileges when it comes to federal student loans that are restricted when your loans are defaulted. They also remove the defaulted status from your credit report, which can be the difference in some cases for things like getting a home loan or not getting a home loan. And it says, and I quote, "The final rule will allow a borrower to rehabilitate a defaulted loan twice over the loan's lifetime. Previously, borrowers were only able to rehabilitate a defaulted loan once. By rehabilitating a loan through 9 on-time voluntary payments, borrowers can restore their loans to good standing and regain access to the federal student loan programs. Importantly, this limit applies to each loan a borrower holds rather than the borrower." I stop there because that's an important distinction. Previously, Brenton Harrison, was limited to going through the rehabilitation process one time, no matter if it was for 1 loan or 20 loans. What they're saying is, say for example, you have 10 different student loans, you can now go through rehabilitation twice for each of those 10 loans. Conceptually, that would mean you could go through rehabilitation 20 times, although if that were the case, I'd be saying, what in the world is going on with your federal student loan payments? Going back to the sheet, it says, additionally, the department has made important changes to the process for borrowers who successfully complete rehabilitation. At the time a borrower signs their rehabilitation agreement, they will have the opportunity to opt in to enroll in an income-driven repayment plan effective once their rehabilitation is completed. End quote. This means that instead of the previous process where you get through rehabilitation, your loans are taken out of default status, then you have to reapply for an income-driven repayment plan and start the process all over. They're saying at the start of rehabilitation, you can choose your income-driven repayment plan option for the end of the process, and when rehabilitation is completed, you will automatically roll into that plan. The last few things, knocking it out, and then I'll let you go, are deferments and forbearance. And this says that borrowers will still have access to a general forbearance of up to 9 months within a 24-month period. Now, this is a departure from previous standards. It used to be that you were able to take forbearance and deferment for 12 months consecutively, 36 months cumulatively, but they are saying that they are still preserving your ability to have general forbearance, although they are sunsetting your access to economic and unemployment deferments for any loans that are made on or after July 1st, 2027. Again, an important distinction. If you already have loans, you have the same privileges when it comes to deferment or forbearance that you had before. We're talking about with these rules, what will be set in place for newly created loans after July 1st, 2026. In most cases, in the case of deferment and forbearance, it's July 1st, 2027. Next up, it says institutionally determined loan limits. And it says beginning on July 1st, 2026, institutions may limit the total amount of loans a student or a parent borrowing on a dependent student's behalf may incur for a program of study, provided any such limit is applied consistently to all students enrolled in that program, basically saying they can't discriminate by placing a lower loan limit on a certain student. It has to be applied across the board. I can tell you with almost certainty, I don't see there being many colleges out there that are going to limit how much their students can take out in loans, but they now have that option. And lastly, loan limits for part-time students. Beginning on July 1st, 2026, institutions will be required to apply a schedule of reductions formula to reduce the annual loan eligibility for students who enrolled less than half time. This means that they can't find a workaround for certain programs where they're saying, yeah, loan limits are reduced, but if we can find some way to have you listed part-time, maybe there's a way to kind of get more juice from the squeeze in terms of what you can borrow in your course load. This is saying that's not the case. If you have a student who is not enrolled for a certain period of time, they don't also get the benefit of borrowing up to those loan limits. So the overarching theme is if you have student loans already, I would be very hesitant to borrow any more because those future loans would restrict or even eliminate many of the options that you currently have at your disposal. If you are considering borrowing on behalf of your child, as I've shared in previous episodes, unless you have just sheer, utter financial confidence that you can pay the loan off in full with no forgiveness, I wouldn't do it because you won't have access to forgiveness. And I do think that this may change the structure of even how people pursue degrees. You might find people who are more inclined to do their generals at a place like a community college and then do the last couple of years at the school of their choice. Maybe more kids who take part-time hours so that they can work to cover the additional cost of tuition, or those who go for a year, go home for a year, go for a year, go home for a year. But I do think we're going into a new era of what the structure of college education looks like. And these finalized regulations, at least until we have a new administration that comes in and has the opportunity to change them, has definitely altered the lay of the land in a way that could be impactful. I'll see you next week.
Let's get some money.
From New Money, New Problems, this was the New Money, New Problems podcast, a show for successful professionals searching for the tools they need to navigate financial opportunities and obstacles they've never seen.